Many investors use a securities-backed line of credit, SBLOC, to avoid taxes. A securities-backed line of credit is a type of low-interest loan that uses your investment portfolio, your securities, as collateral. You can borrow up to a certain percentage of the value of your securities without selling them and disrupting your long-term investment strategy, which should be to hold onto your shares in a company for a minimum of 10 years. You can use the money you borrow from your securities-backed line of credit for whatever you want, except for buying public stocks. Here's where it gets really interesting though. Since the money you borrow is debt, and not income, you're not taxed on it. No taxable event is triggered when you withdraw from your securities-backed line of credit. Not even capital gains tax, since that only triggers when you actually sell your securities. Furthermore, as mentioned previously, the even bigger long-term benefit to this strategy is that you also avoid selling shares, so you can let your investment grow. You'll be taking advantage of what's called the time value of money, TVM. The time value of money refers to the idea that money in the present should be worth more than that same dollar amount of money in the future. This is because money that you have right now can be invested and earn a return, thus creating a larger amount of money in the future. Also, with future money, there is the additional risk that the money may never actually be received, for one reason or another. The time value of the shares that you're able to avoid selling by using a securities-backed line of credit should be far higher than what they'd be worth if you were to spend them as cash today. Since your investments should grow substantially over the next 10 plus years, you'll be holding on to them. Assuming you followed my advice, smile. This may sound too good to be true, but it doesn't come without risks and limitations. Here's what you need to be aware of. Margin call risk. Since your portfolio's value is the collateral for the money you borrow, its value must stay above a certain amount in order to avoid being margin called. If the value of the securities you're borrowing against drops below a certain level, you may face a margin call and have to either deposit more collateral or repay part of the loan, until the value of your securities goes high enough to be out of margin call territory. Another risk to be aware of with this strategy is compounding margin interest rate risk. The margin interest rate is the amount of interest that you have to pay on the borrowed amount from your securities-backed line of credit. You will be responsible for paying interest on an ongoing basis, usually monthly. The interest rate is usually variable and depends on several factors, such as the market value of your securities, the type of securities, the loan amount, and the lender's policies. The margin interest rate on a securities-backed line of credit is typically lower than other forms of borrowing, since you are pledging collateral, your securities, to secure the loan, so there's minimal risk to the lender. However, it can also change every day based on market conditions and lender's discretion. The margin interest rate is calculated by adding a spread, a percentage point or more, to a base rate, such as broker call, prime, SOFR, or LIBOR rates. For example, if your lender uses SOFR as the base rate and adds a 2% spread, and SOFR is 1.5%, then your margin interest rate will be 3.5%. The spread may vary depending on your loan size and other factors. Pro tip: negotiate your spread and make sure it's fixed. Interactive Brokers usually has some of the lowest rates in the industry, so you can point your broker to them and ask to match it. Aim for a 1% to 2% fixed spread. I'd say just use Interactive Brokers, but I've heard they aren't as forgiving as other brokers when it comes to margin calls, as they save on costs with a more automated and less human-involved platform. Some brokers will offer a generous bonus to you for simply funding your account with enough money or shares as well, so make sure to ask, always. I say always ask because they may even offer it to you as a special deal to get you to open your account with them instead of a competitor. The bonus could be thousands of dollars. When it comes to the base rate piece of the margin interest rate, this can't be negotiated and is really just determined by the Fed funds rate, which is controlled by the Federal Reserve. This is another big risk to watch, which became very real over the past year, as we've witnessed a historic rise in the Fed funds rate, which has gone up by over 4% in the past year, not the norm by any means. 6. Okay, so here's where you need to really pay attention. Since this strategy requires letting your loan pay off its own margin interest each month, this means the interest on your debt is compounding, which means it will accumulate quickly. Make sure you're accounting for it and monitoring it. However, here's where some basic math and financial engineering come into play. If your investment returns compound faster on a percentage basis than your margin interest rate plus inflation does, then you win. If not, then it won't sustain. You may be wondering how much to add for inflation in this equation. Consumer Price Index, CPI, growth rate is the standard metric used by the Bureau of Labor Statistics to keep track of inflation. Despite it peaking at over 9% recently, the average CPI growth rate over the past 50 years is 3.5%. I'd recommend using 4% for inflation. One thing to keep in mind is that time in the market is more important than timing the market. And all it takes is a few good days to make up for several years of stagnation or loss, so you certainly can't expect your returns to be linear. Don't lose sight of what you expect the value of your investments to be in 10 plus years. There's obviously no guarantees, but hopefully your investment returns outpace your margin interest plus inflation over the long term. Some investors are able to follow the buy, borrow, die strategy, which involves using this securities-backed line of credit strategy until you die. With current law, as of 2023, when you die, your heirs inherit your securities on a step-up in basis. Step-up in basis means that the person inheriting the shares in your portfolio does so as if they bought those shares at their current stock prices, even if they had already gone up 10x in price from when they were actually purchased. This is a massive benefit to them, since now it's as if the IRS doesn't recognize the capital gains made thus far and they're reset to $0 in their eyes. Which means your heirs only have to pay capital gains tax on any new gains made from this point, only when they go to sell the shares eventually. One last thing to be aware of with the buy, borrow, die strategy is estate tax. An estate tax is a tax levied on the transfer of property after someone dies. By current law in 2023, the borrower may have to pay estate tax on the value of their estate above a certain threshold, currently $11.7 million per individual or $23.4 million per couple. The estate tax rate can be as high as 40%. Who pays the estate tax on a securities-backed line of credit depends on how the loan is structured and who inherits the assets. Generally, there are two possible scenarios. 1. If the borrower dies and leaves their investment portfolio to their heirs, then the heirs will inherit both the assets and the debt. They will have to repay the securities-backed line of credit or sell some of the assets to cover it. The estate tax will be calculated based on the net value of the assets minus the debt. 2. If the borrower dies and leaves their investment portfolio to a trust or a charity, then they may be able to avoid or reduce estate taxes by removing those assets from their taxable estate. However, they will still have to repay the outstanding loan amount. Setting up a securities-backed line of credit may seem very intimidating and complicated at first, but it actually only takes a few minutes to set up. Just search for portfolio line of credit plus your broker's name in Google. You shouldn't even have to get on the phone, but that's usually an option if you need help.